What is an adjustable rate mortgage? So, an adjustable rate mortgage is a mortgage where the rate can change. Now, there's a couple different versions of an adjustable rate mortgage. More than likely, if you're getting like a 30-year mortgage, like to buy your house, you're not refinancing or getting a home equity loan. You're going to do an adjustable rate where the rate could change after a certain period of time. Normally, the way it works is, believe it or not, it's actually the rate is fixed for a short period of time. Normally, it's like between 2 and 5 years. Okay. So you'll get that rate, whatever it is, for 2 to 5 years. Then, after the term is over, that fixed term, what's going to happen is the rate going to adjust based on a certain parameter. Sometimes it's the LIBOR, sometimes it could be the Wall Street Journal prime rate, depending on the type of loan. There's a lot of different things it can be, the rate could be associated with, right? Depending on the changes. With the most of them is the LIBOR. And what will happen is at the end of the fixed term, the lender's going to analyze your interest rate. It's going to look at your rate, it's going to look at the LIBOR. Now, if the adjustment is 1 or 2 or 3 or 4% higher than LIBOR, that's what your rate will change to. Now, most of the time there's a cap, and most of the time that there's terms to it. So your most traditional is after the 5-year fixed period, your rate can adjust, but can be no more than 2% higher than your original rate. Then every year on the loan anniversary, going to adjust. Now, your rate will never be over a certain percentage high over what your original was. And most of the time, that cap is 5% over what your original rate was. So let's say you got an adjustable rate today, and hypothetically, let's say it's 5%. If you're doing an adjustable rate mortgage, and let's say the cap is 3%, that means your mortgage will never be higher than 8% for the interest rate. Okay. And it's going to adjust every single year. This can be good and this can be bad. In a situation like we are now, this could actually end up being pretty good for you as we're all hoping rates drop. But there's no promise that they're going to drop. It could be really bad if rates go up. You got to weigh that. But remember, it is fixed for a certain period of time. So if you want to roll the dice and you're like, you know what? Let me lock it in for 3 years. And then at that point, it's going to adjust. As long as you're attentive and before those 3 years is over, you pay off or refinance into a fixed rate, or if the rates look like they're going to drop, you may stay in it. You want to make sure you pay attention to what's going on in the market and pay attention to what's going on with the rates. Now, that's when your mortgage rep comes into play, because you want to stay in constant contact with them to find out what's going on in the mortgage world and what they should do. So adjustable rate mortgages, or ARMs, as they're more commonly known as, are not bad things. They're actually really good products that, if used correctly, can really help someone in a situation. In a situation where we are right now, sometimes it's actually a better deal to go with an adjustable rate. Sometimes, depending on the property or the type of financing we have to do an adjustable rate. And you're going to find that mostly with like your business loans and your investment properties and your out of the ordinary, out of the box type loans. But an adjustable rate mortgage should not be feared as long as you understand it completely, you've analyzed the risk, and you're okay with taking the risk. Because remember, it can always go up. So just have a plan in place so that you don't get yourself stuck once the fixed term is over. Now, there's another type of loan, the HELOCs, the home equity line of credits, or the home equity loans. These sometimes are also adjustable rate mortgages. Now, most of the time, if you're getting them directly from a bank, they're going to be adjustable based off of the Wall Street Journal prime. That can change monthly, and that interest rate can change monthly. So where you're doing with a mortgage is typically on the year anniversary, it's going to adjust. A home equity loan or a HELOC from a bank potentially could adjust monthly. So always read your fine print. Always make sure you understand what you're getting into before you finish is the best advice I can give. But don't knock it just because you're scared of it. Because a lot of times it really can be a good product. And most of the time, as long as you're working with a professional who is always going to be there for you, they will help you through the getting the product, understanding it, and also after the fact, making sure that you can make the right move when you need to. So that's basically an adjustable rate mortgage. It's when the rate can adjust based on certain parameters. And it sounds scary, but again, under the right circumstances, it is a phenomenal product that can help many people. All right. So as always, shoot your questions in the comments, like and subscribe to my page.